Hi, everyone. Welcome to the Real Estate Private Equity Show. I'm your host, Ava Benesocky, and of course, I'm joined by my amazing co-host, August Biniaz. Guys, we have a really exciting interview for you guys today. So if you can please like and subscribe, as it helps us build our channel and allows us to keep bringing you great content, great expert guest speakers, and of course, we try to bring as much value as we can to you guys.
Yeah, you're going to be particularly excited if you like data and numbers and growth metrics and all of this item because the guest that we have today is truly the master of his craft when it comes to these things and when it comes to data and when it comes to all the other great stuff here. So we can't wait to explore rent growth and population growth and how it affects our yield. So great.
Amazing. Yeah, we're joined by the guru himself, guys. His name is Carl Whitaker. And a little bit about Carl. He is Director of Research and Analysis for RealPage Inc., where he blends in his passions for geography, economics, and teaching to foster a practical, applied understanding of apartment trends and forecast expectations. Prior to joining RealPage, Carl worked as a consultant with Catalyst Commercial, an economic consulting firm based in Dallas. Now, Carl received a bachelor's degree in secondary education and a master's degree in applied geography from the University of North Texas. So August and I believe this interview with Carl will bring value to both passive and active investors looking to learn about the 2022 multifamily rent growth and if this trend is poised to continue. So welcome, Carl. Thank you so much for being here with us today.
Wonderful. Well, thank y'all for having me. I really appreciate it. And I have to say that it's easy to do well in this role when the data helps you look good. So really appreciate y'all having us on and excited to talk some trends here.
Yeah, it's better than that though, because every time you do a post on LinkedIn, I can't wait to get on there and read what you're saying because you also back up by, reasoning about the data that you share. So really excited to have you on.
Yeah, absolutely, Carl. We learn a lot from you. But if you can please, let's start off by please talk to us about your background and then your start in real estate.
Yeah, I'll try to keep it pretty short. So happy to dive in more if I need to. But my intro to real estate was pretty similar to a lot of people's. I didn't necessarily intend to end up here, but just the path of life kind of took me down this route. As you mentioned, Ava, my background is or my master's degree is in geography, which obviously has a little bit of overlap with real estate, broadly speaking. There's some nuance there, of course, but started working with Catalyst Commercial. That was kind of a blend of economics and city planning. If let's say a city has a shopping center that they're trying to reposition, what type of retailer do you bring in and why? What makes sense based on local demographics? Are you comfortable underwriting this cap rate if it's this sort of entity that comes in? And funny enough, we were actually a client of Axiometrics at the time for the apartment data. And as part of these comprehensive city studies, we would look at best and highest use of individual sites within cities. If it's 20 vacant acres, does it make sense to build single family, multifamily, office, retail, et cetera, et cetera. And then just through proxy of acquisition, ended up coming to RealPage. So that's kind of how I ended up here in real estate and more specifically in real estate data.
Awesome.
Okay.
Talking about RealPage, we're looking to switch investor portals and we're looking to get their RealPage IMS. So we're excited about that. All right, cool.
Now, before getting into the current market rent trends, could you educate us and our audience about how data is collected to prepare the RealPage reports, please?
Yeah, absolutely. There's a few different ways that we collect our data, and there's really two distinct data sets. And I think it's good that we're touching on this up front because it is an important distinction. We do have part of our data coming from our market analytics platform that is collected through traditional market surveys. That's going to be by calling individual properties and asking, okay, what is your rent on your available 500 square foot, one bedroom, et cetera, et cetera. What's your current occupancy rate? Are you running any specials? That's going to be the very traditional market-based, market survey-based research. We do also have, through proxy of a lot of the data that RealPage, or a lot of the products rather that RealPage is providing, we're able to tap into roughly 14 million individual lease transactions, meaning that we are able to see behind the scenes on actual rent roll data. Now, obviously, this data gets anonymized before it's aggregated, so we're not able to see individual lease transaction, but through proxy of using that data, we can say, okay, the new lease trade out at this individual property was 15% year over year based on same store set of parameters. So that's going to be the lease transaction database. That's a little bit more new agey, if you will. So we do use these data sets complementary to one another.
Got it. Because I believe there's 44 million apartment buildings or communities in the US. 20 million of them are being professionally managed. So to get the data, there needs to be a lot of legwork for you guys to provide us as investors and consumers with such great information. All right.
Yeah, absolutely. Now, Carl, we wanted to discuss the 2022 rent growth, but first maybe we could start with 2021. And, as the pandemic forced the Fed to bring the interest rates near to zero, it pretty much created free debt, I should say. The markets kind of went hyperbolic then. So can you give us a storyline on what happened with the rents starting in 2021, and then did the trend continue into 2022?
Yeah, and I'll actually go back a year further to 2020 just to help contextualize 2019. What we saw in the initial downturn was that there was this pretty heavy bifurcation in rent growth where you had the high profile coastal gateway markets, your San Franciscos of the world, your New Yorks of the world, obviously garnered a lot of media attention. But if you looked at markets across the Sun Belt, stretching from Phoenix, we were talking about Phoenix in our discussion earlier. If you looked at Phoenix, the Texas markets, many of the Florida markets, Nashville, et cetera, those metros actually performed pretty well in the grand scheme of things. And then you had a third subset of markets there in the nation's Midwest. Chicago was a little bit different, but Cincinnati, Columbus, Ohio, et cetera, kind of your slow and stable markets, they remained pretty slow and stable. So 2020 was really a year of heavy bifurcation. What we saw in 2021 was, as you pointed out, that almost hyperbolic increase in rents. But what we also noticed was that it was about that same time that renter incomes were also beginning to grow at a really rapid rate. And in some of the materials that I provided here, I think it's slide 12 shows that renter income growth as well. And you'll notice that
Let us share the
slide 12
here briefly with everyone so they can see where we're at. Do you is it
do that? Yeah,
it'll be a green slide that's got a dotted line.
Let's see here. Slide.
You can see the slides right there. There's three.
Got it. 3, 4. Slide
12.
And if it's not 12, then I may have sent over a different deck for this conversation. There we go. So it is. Okay, good. I did send the right one. So what you'll notice is that in 2021, this is being captured through RealPage's lease transaction data set, and it's looking at the average reported income on newly signed lease agreements. And about that same time, those numbers really started to increase rapidly. And I think that showed some of the external economic tailwinds that were happening. And by tailwinds, I mean you're seeing stronger wage growth, particularly in that professionally managed apartment style renter. Oftentimes these are college educated folks starting out in their career, advancing in their careers. So there was some significant wage growth happening overall. So really, I think 2021 was a year where rent growth was pretty substantial, but you were also seeing substantial income growth as well. And I think it's important to note those in conjunction with one another, because in our view, we're not necessarily seeing too many affordability challenges, at least broad-based. That's not to say that there aren't individual anecdotes where that's the case. And obviously we want to be cognizant of that and mindful of those challenges. But by and large, you're seeing similar growth of incomes to what is happening with rental rates as well. So all this to say, 2021 was really a year of strong rent growth, but it was also a year of strong accompanying income growth as well.
Got it. Awesome.
All right. Thank you for showing that graph. That was very, very helpful. What's the next question, August?
All right. So we're multifamily investors. Our focus is on multifamily. And I believe the rent growth in 2021 was 20% nationwide. Now, is that 20% residential, multifamily? Is that all commercial real estate asset classes combined? What is that number?
Yeah, that's a good question. It's hard for me to say much about other commercial real estate sectors just because RealPage is so hyper focused on conventional market rate multifamily. But to your point, August, the numbers are pretty close there. I think 2021, we saw 16 to 17% rent growth overall. So those numbers are pretty closely corroborated with what you've said there. From what I've heard anecdotally, I have heard that the industrial sector has seen similarly strong rent growth. Office and retail maybe a little bit more challenged, but we have seen overall in terms of commercial real estate. I do know that multifamily is making up a bigger and bigger share of the overall pie. If memory serves me correct, I want to say 2021 was something like 42% of all commercial real estate property trades were multifamily, and that was up from 30% in the previous real estate cycle. So lots of capital flowing into apartments that may be coming from other avenues, i.e. retail, office, et cetera.
Amazing. And within the multifamily sector, the different asset classes, do you have any data or numbers on which asset class A, B, or C was the best performing when it comes to rent growth?
We do. And actually, if you go to slide, let's see, that's going to be slide number, looks like slide number 6 there. It'll be a circle with some 3 lines stemming off of it. And while we're pulling that up, one of the things I think that candidly surprised us when looking at these numbers was that it wasn't strength happening in just one asset class that was driving up all of the numbers. It was ubiquitous strength where Class A occupancy was pulling up to record levels. Same with rent growth. You could say the same for Class B. If maybe there's a slightly weaker product class, it's going to be Class C. The occupancy numbers look a little bit stronger, but what I would note there is that Class C business oftentimes tends to be a bit more of a cash flow business. And if you look at rent growth for that product class, especially on lease renewals, they're growing at about the same rate that the CPI or the inflation rate is. So I think Class C is probably a little bit softer and maybe being masked by some of the overall economic tides that are lifting, for lack of a better term. But I think the surprise for us was just how well Class A has responded, particularly considering we're seeing record construction levels today.
Got it. Got it. Awesome.
Awesome. Okay. On to the next kind of topic. I wanted to discuss interstate migration with you. This great migration of people moving from California and New York to the Sun Belt. We assume this has added to the rent growth in these markets, but do you have any data or evidence that shows the migration will continue? I think we were talking to a partner of ours, and they were, I think you mentioned that Texas is expecting about 1 million in migration over the next 10 years.
Yeah, and I can see if I can check on some of that data. And I actually happen to be based out of Texas, so I can at least offer some boots on the ground insight there. I think broadly speaking, the way we're looking at some of the migratory flows over the past year is that COVID accelerated some trends that were already happening. You were already starting to see California population growth was slowing. Now, it wasn't declining, and the past 2 years has been very different in that regard, but growth was concentrating more along these Sunbelt states in a lot of ways. COVID accelerated that trend. Something that struck us really fascinating in the migration data here as of late is if you look at resident retention rates, or the percent of residents who are electing to renew their lease, you're not necessarily seeing a big move back to places like California or New York. In other words, if somebody moved to Florida 2 years ago, it doesn't appear that there's a lot of people moving back to their original home markets. Not to say that it's not happening in some instances, but at this point, it looks like most of the migratory inflow has been more or less solidified. Now, having said that, I think the pace of growth out of, say, California and into Utah or Idaho or Arizona, that's going to start to slow down now that some of the measures that made California attractive to begin with, high quality of life, close proximity to really high quality employers there in the Bay Area, for instance, those things are starting to normalize. So I think the pace of migratory flows is going to start to rebalance here in the near term. But I do think that, some of the trends that we were seeing over the past 2 years, again, were already in place. It's just that COVID accelerated them.
Quick question for you that comes up is, here in Canada, obviously we're a nation of really immigrants. Every year, historically, recently, we would bring in 300,000 immigrants. We're planning the mandate, really the government immigration mandate is now 1.3 million over the next 3 years of immigrants. And that's going to, most of those immigrants want to live in Toronto and Vancouver, the large cities. And that's going to, the demand is just going to go through the roof. But I most of the time don't hear in the US talking about immigration, but US is even more of an immigrant nation than Canada. Is there any kind of research on actual immigration to the US coming from South America, Central America, and other places around the world, and how that affects real estate?
Yeah, that's a fascinating question. And it's been a little bit hard to get our hands, or at least it's been hard for me to get my hands directly on some of that data. But the data that I have seen suggests that population, or I should say migration coming from the Central American states, particularly Mexico, has been really, really suppressed over the past 2 years. And interestingly enough, we're seeing some of those states like Arizona, Texas, et cetera, that were destination spots for many of those migratory inflows have slowed on the international migration side, but they've picked up on the domestic migration side. So I think the overall numbers kind of wash out to look more or less like, hey, migration happened, but it wasn't from the international side. And if you extend that a little bit further to the nation's West Coast markets, for instance, one of the things we saw happen with student housing in particular was that many of those areas, the University of Washington, Cal Berkeley, UCLA, et cetera, those real big marquee brand name universities on the West Coast have essentially missed out on 2 years worth of exchange students coming from the Asian states. And I think we're seeing that also happen on the conventional marketplace side, where you're not seeing as much migration happening from those parts of the world. Now, whether or not that continues, I think that's going to be kind of a tricky glass ball or a crystal ball type scenario that maybe takes a little bit of time to see how that shakes out. But it's a fascinating question because the components of migration are oftentimes just as important as the overall migration numbers.
Absolutely, especially when you have China and India, two of the world's most populated countries, and a lot of times, on the professional side, a lot of times the brain drain that happens from China and India into the U.S., into California for all their tech stuff. A lot of times people are from that demographic, but also, India is having one of the, I think, the world's largest middle class now, over 300 million. And obviously China, with the economic boom they've had, a lot of time they look for the West to buy a home and for their children to go to school, like has happened. We live in the city, Richmond is a suburb of Vancouver, and it's over 70% Chinese population, with a city of 200,000 people. So Ava's never seen so many Chinese restaurants and Chinese food. She's like, I thought Chinese food was sweet and sour pork. I'm like, no, they have
chicken fried rice, but I'm having one of the best dishes in
like,
my world. I've been missing out all my life.
They have 5,000 years of civilization. They got
Yeah.
more dishes than the Italians and the French combined. So
I gotta
yeah,
say, Szechuan is my fave. Szechuan is my fave.
Yeah, the spice in that's really good. And like you said, once you get true, authentic cuisine like that, it's hard to go back to the standard stuff.
Nothing beats it. I mean, you're not living life until you get to taste some of this kind of food.
awesome. Yeah, let's get to the next question. Do you mind if I steal this question from you?
You go ahead.
All right, great.
We're
Let's
fighting over who gets to ask you questions now.
yeah, let's talk about affordability. I mean, it's a very important topic, because here at CPI we serve our tenants. Essentially, we're in the business of servicing tenants and serving our tenants. So it's important that those tenants can afford and continue to afford to live in apartments and what type of apartments they seek. But 70% of American population can afford to buy a home. In most cases, this means people renting apartments. But with the rents continuing to grow, as we've had this conversation on our meeting today, where's the peak? Where is the tipping point? We know that wages are also increasing, like you mentioned earlier, but not at the rate that the rents are growing. So, what's going to give first here? Is there's going to be a balance coming down the pipe here? Give us your thesis on this.
Yeah, it's a good question. I think with multifamily, we're probably going to see less susceptibility to pressure coming from affordability challenges. And what I mean by that is, if you look at the single family side, there's a really heavy supply imbalance as opposed to a demand imbalance. Now, on the multifamily side, there's certainly some supply constraints, but if you look at a longer term graph for permitting, and as a matter of fact, I do think I have this in the slide deck. If you scroll down to slide number 35, it looks like. And as you're pulling that up, I think some of the drivers that have caused some of the single family home appreciation in particular in recent years has been that there's just a huge undersupply of housing. In fact, only here in the past few months have we got back to pre-Great Recession levels of permitting. So yeah, that's that blue line right there. You can see that in February 2022, about 800,000 single family homes were permitted. That's the most that have been permitted since, what is that, 2007? And they're basically just getting back to the 1990s decade norm. So I think we've seen this huge undersupply of single family housing in particular has really constrained the market affordability there. Conventional multifamily housing, and now keep in mind this is looking mainly at professionally managed and owned properties, so I do hesitate to paint with too broad of a brush and looking at some of the non-professionally managed properties, but affordability challenges haven't been quite as significant, nor have they been quite as supply constrained, because those multifamily assets have been building at a more stable, healthy pace. Now you're still seeing some shortage of housing, but I think it's less so on the multifamily side and more so on the single family side.
Got it. Got it.
All
Great.
right. Okay, so now let's discuss the current increasing interest rate environment which we are currently in. What is the correlation between interest rates and rents?
Yeah, so the correlation there is probably not quite as clean as it is on the acquisition side or the capital market side. I'm sure I'm preaching to the choir here in some ways, but as those interest rates have increased, it's been harder to secure some deals in some ways. And again, going back to the last point on single family housing, as we see these interest rates continue to rise, I think we're going to see fewer buyers of homes in addition to fewer people willing to sell their homes, because then they're confronted with the same issue that the buyers are of, hey, there's already a limited availability of housing, plus my mortgage rate is going to increase versus what I currently have locked in. So it's a bit of a catch-22 in some ways, and thankfully there's smarter people out there than me that have to figure out this broad-based issue of rising interest rates and how that impacts the economy. But I think going back to the question here, maybe more specifically, it's a bit harder to draw a clean correlation between rising interest rates or falling interest rates and the price of rental appreciation than it is looking at single family home price appreciation. Now, if there is one area that maybe you see some level of additional correlation, I would say it would be Class A rent growth in some of these markets where historically you may be at risk of losing a renter to single family home purchase based on the difference between a Class A rent and what a mortgage rate would be. So for instance, I'll actually share an anecdote here. I purchased a house here in McKinney, Texas, which is one of the northern Dallas suburbs, in 2020. My rent at the time was about $1,450 per month. My mortgage that I ended up securing was about $1,600 per month. So I think 2 or 3 years ago, you had that scenario of where someone maybe already looking to buy is almost incentivized to purchase if that rental rate got too top heavy and pushed them towards single family housing. But today, and maybe I'm looking through much of a Dallas focused lens here, but today it's almost impossible to find a home in these northern counties for under 400,000, and even Class A rents are at a level that isn't tipping residents into the single family for purchase buyer pool. So maybe that's where the interest rates do have a little bit stronger of a correlation. Rising interest rates could translate to slightly stronger Class A fundamentals, I guess is what I would use as a quick summary sentence there.
Great input.
Great. Thank you for explaining that to us. Now, with interest rates on the rise for the first time in almost a decade, investors are kind of wondering if cap rates are going to follow the suit. Do rising interest rates always mean rising cap rates and consequently lower values?
Yeah, I guess it's hard to say because you never want to say that it always translates one to one. But I think what we're seeing on the at least on the multifamily side that I've seen thus far, it's that the rising interest rates haven't necessarily discouraged buyers, but how much are sellers willing to budge from their expectations to meet that of the buyer? And what I've been hearing anecdotally is that we talk to a lot of investment and capital groups where they've still got the appetite to acquire. I think August, you mentioned earlier, Phoenix has a cap rate in the low 4% range, which is just crazy to think about. Certainly 10 years ago, but even 5 years ago, the buyers are still looking at a market like that as a favorable investment vehicle based on fundamentals, performance fundamentals over the next few years. But I don't know how much we've seen seller expectations adjust to rising interest rates, because a 1% increase in an interest rate obviously influences the buyer's underwriting. It doesn't necessarily influence what the seller wants to achieve on their exit. So I think there's still maybe a mismatch, and it'll take some time to balance between what those buyer and seller expectations are. But I do think we'll find that equilibrium at some point. And again, thankfully, it's smarter folks than me that get to figure out what that equilibrium is.
Yeah, for sure. And hopefully, as all this liquidity and all this capital, from different asset classes that poured into multifamily over the last couple of years, as they go back into hospitality and retail and office space, hopefully that will lower the demand here a little bit, and make it a little bit more of a reality check for the sellers of multifamily projects. But we know how that works because we've seen it happen here in Canada a lot. That the certain demographic that own properties, they're just so reliant on that, what their property is appraised at, they're not budging. But all right, interesting to see that. Okay. So interesting question. So cap rate. So I want to discuss again, bring a comparison and talk about, compare Canada, particularly Vancouver and Toronto, Los Angeles and New York. And we talk about cap rates being around that 2.5% in most of these large cities where people want to be in. And the reason for that is really risk, because you buy something in New York, in Los Angeles, in Vancouver, Toronto, the likeliness of the property, the natural market appreciation continuing is very high. The demand is going to be very high, so that's why the cap rates are low. But as we see with places like Phoenix, the cap rates keep compressing, like we discussed before the show started, and as you've alluded to, we see that the cap rates are compressing so much. Is this a trend that we're going to see continuously happening in these up and coming regions, up and coming cities? Are all roads going to end up in Rome? Is it going to be that this is going to be a trend that's going to continue everywhere, where cap rates get so compressed that it no longer makes sense for our business model? Like, for example, CPI Capital can acquire multifamily assets in Vancouver or most places in Canada because it just doesn't have the cash flow and the appreciation, and then we go do forced appreciation. That's why we're in the Sunbelt states. But if the Sunbelts are turning into Vancouver, then we might be out of business. So tell us about what's your prediction? How do you see this happening? Because it's just a trend that's continued for so long now, the cap rate compression.
Yeah, I find it fascinating hearing the Canada versus US comparisons too, because even though very culturally similar in a lot of ways, there's some pretty stark differences between the Canadian real estate market. As you point out, there's half a dozen metros that have big time investor interest, and then the drop off after that's pretty steep. I have a friend that actually is from Thunder Bay, and I'm not sure how much investment capital Thunder Bay is pulling in versus, say, Toronto or Vancouver. I think here in the States, it's a little bit different, where historically maybe a Nashville or a Charlotte was like, well, okay, it's second tier. Maybe we'll look at it. Probably not. But I think now, based on how some of those markets have grown in some of those states, not only do the demographics and the economic growth suggest that those are viable investment targets. To your point, I think if you look at that cap rate compression in a San Francisco, not to mention just the price per unit in a San Francisco versus that of a Phoenix or a Salt Lake City, it is almost incentivizing some investment groups or some capital groups to start looking at the Sun Belt with more earnest. Now, as far as that cap rate compression and can it continue, it's hard to foresee a scenario in which they continue to compress at the rate that they have over the past, let's call it 2-ish years at this point. Certainly, I think that there could be some further contraction that happens, but I don't necessarily see it happening at the rate that it has here recently. Interestingly enough, if you look at some markets in the Midwest in particular, thinking about Columbus, I think I mentioned that earlier, Detroit, et cetera, those areas haven't seen as much investor interest, but those markets actually have cap rates in the mid to upper 5% range. So, there's still yield to be achieved out there in some markets. I think where you run into some headwinds there is that how much liquidity do you have in a Milwaukee or a Columbus versus how much liquidity do you have in Miami, whereas Miami maybe historically was a mid 5 cap and today it's a low 4 cap. I don't know that you'll necessarily see Miami get to a 2 cap, but I think that market could go down to, let's call it 3.5% to 4% more quickly than it will start to, I don't know if recompressing or uncompressing is a word, but I could see those numbers, maintaining where they're at for some time until some sort of fundamental shift comes in.
Got it. I wonder if there's like a tipping point for a city that when it gets to a certain GDP or a certain population, that it tips that point where the interest rate and cap rate spread becomes inverted or becomes at par. So I wonder what that takes place, because we can see it happening in a lot of different cities. But it's interesting to follow this trend. Okay, awesome.
Okay, Carl, we'd like to discuss multifamily ground up developments. Now, we know this for a while, that since 2008, there's been a lag between the demand and supply. Do you have any data on this? And are you seeing developers taking the plunge and getting back into the market?
Yeah, so if you pull up that chart, I think it was the one that had the blue line on it, the blue and gold line, slide 35 there. To your point, Ava, there was that point back in the Great Recession where permitting activity dropped pretty substantially, took a little bit to recover. Now, it didn't take as long for multifamily permitting to recover as single family permits. So the reason I bring that up is if you look at the past year, there was barely a hiccup on the multifamily permitting side. And from all the data that we've seen and all the conversations we've had, that hiccup there, let's call it February 2021-ish, was less due to developer appetite, and it was more due to just administrative. It was hard to get these things pushed through because there weren't enough people working in an office to actually get it pushed through. That's whenever we were all just trying to figure out how to get our hands on the situation. And with this being a trailing 12-month number, that's going to lag obviously about a year. So that's when you start seeing that brief dip. Now, the reason I point that out is if you look at today's permitting activity, it's at a record level for multifamily permits. So I think developers have already taken the plunge there in a lot of ways. They're probably, or I say they are looking more closely at markets in the Sun Belt, a little bit less so in some of those coastal gateway markets, not only from a performance expectation perspective, but also just from it's a lot harder to get a deal to pencil out in Manhattan today, certainly than it was 10 years ago, and certainly more so than that historically. But I think you're seeing developers take the plunge. I think what's interesting, and I don't know that we'll get too much into it in this conversation, but what's interesting is to see how much of the permitting activity is actually showing up as single family, but it's single family for rent housing. We're seeing a big trend of build to rent, and there's been a lot of permitting activity centered around that here lately. And again, being here in Dallas, I see it all around where there's big communities that are single family build to rent popping up left and right, it seems like. So I think if there's a trend that we really want to watch in the near term, it's going to be how much of this permitting activity essentially functions as multifamily, but is technically single family just by nature of how that build works.
Great. I'm going to come out and just say that even as a multifamily investor, I am the most bullish on build to rent single family,
You
just
have
because,
been, yeah.
you know, when you do it, you can do it in segments. When
Yeah.
you're building a multifamily structure, you can't just say build a little bit of it and then rent it out, have some cash flow coming in while you build the next phases. Whereas single family, you could build 10, then move, you know, rent those out, move to the next one, so you can really build big communities. And if things change, you can just sell each single family individually by itself. So you can't really do that in multifamily, even though because of the compressed cap rates here in Vancouver, there was a trend where a lot of apartments turned into condos. It was called condo conversions, and that's caused a big issue here with supply, because a lot of people cannot, there's just not enough residences for people because they have to buy. There's just not enough to rent.
Yes.
All right. Final question before we move to this next segment of our show.
And I'm going to steal this one because I'm really excited to hear Carl's thoughts on this one. Now, we feel a little bit bad about asking this next question, but because we're kind of going to be putting you under the gun. But you are so immersed in the market. What is your prediction for 2023 as far as the highest performing rent growth cities in the U.S.?
I love the question, and certainly not putting under the gun, because this is, again, what we deal with day to day. I think right now we're still probably most bullish on many of the Florida markets and many of what we've been calling here lately the mountain and desert markets. So, the Salt Lake City, Phoenix, markets, essentially markets that are adjacent to California and Washington, those areas that saw a lot of move outs during 2020. I think if there's an area that maybe has some additional upside, it could be some of these gateway markets that just simply based on the timing of their recovery could have some additional upside over the next 6 to 12-ish months. And I liken it to a rubber band. Those markets pulled back so far that whenever that rubber band is let go, they're going to see subsequently large rebounds. And that's just the nature of a high beta market like that. So I think that some of those markets could have some upside potential. There are some more extraneous factors working against many of those markets, i.e. rent control. If you look at Los Angeles right now, for instance, that market could certainly support stronger renewal rent growth than 8% simply based on demand fundamentals, but that gets capped by local legislation. So I think that could be an Achilles heel for some of those markets. Not to say that performance will be weak based on that, but I don't know that they'll necessarily hit their full potential based on that upside. Now, conversely, one of the reasons we're so bullish on, again, Phoenix and some of those Florida markets, et cetera, is that if you look at the difference between the rental rate a resident is paying today versus what a new lease resident would be paying, the gap between those rates in some instances is as big as 20%. So I think that even if renewal rents grew 15% for a resident that's staying in place and a new lease resident saw 0% rent growth, that resident electing to stay in place is still getting a better economic bargain based on that gap or that loss to lease. So the Florida loss to lease numbers are just so drastic right now. And as a matter of fact, I think now that I think about it, one of the slides in the deck here, it looks like it's going to be, I apologize, I should have had this one at the ready.
All good.
Oh, no worries.
Let's do a Control F here. All right, so slide 26 is going to be, at least in my view, a pretty good, reading left to right, those markets on the left are probably our near-term favorites for rent growth. And then as you work to the right are going to be markets that maybe have a little bit more limited upside. It's not quite a one-to-one comparison, because I would call out Raleigh-Durham there as a market that we actually really do like longer term. But that kind of gives you a flavor of areas that I think are maybe more apt to see outperformance. Miami, West Palm Beach, Fort Lauderdale, Tampa, Greensboro, Orlando, Phoenix, Nashville, et cetera.
Oh, right on.
We're going to be looking at this very closely.
That's fantastic. Yeah, thanks for sharing that with us, Carl.
Of course.
All right, amazing. That was awesome. Really appreciate all the information you gave us. Now we're next to the next segment of our show.
10 10 championship rounds to financial freedom. So whatever comes top of mind, I'm going to get started and let's have some fun. Carl, who is the most influential person in your life?
Oh, most influential person. Let me give two answers here. I would say that my most immediate answer is going to be family members just all around. A little bit of background. I grew up in a small town. I actually grew up on a farm here in Texas. And, they always encouraged me to, hey, you can do more than, just staying in this small town. So they've always been a huge inspiration, very influential, love them dearly. In any way possible. And as far as a celebrity influence, I would say that I really, really like Bob Weir, the guitarist for the Grateful Dead. I just love his approach to life, and I think it's been fascinating seeing the Grateful Dead kind of come back into fashion with the younger generation. But I think it's because they have such a lasting message in so many ways.
I would have never guessed you're into music.
Nice. All right, Carl, what's the number one book you'd recommend?
Number one book I would recommend. So I have to be candid and say that I don't read as much as I should. That's definitely something that I should read more. My favorite
analyzing
book,
data.
Your mind is consumed.
yeah, and it's funny, August, that you say music, because that tends to be my vice when it comes to entertainment. Is I just dive into music more fully. So I don't dive into books as often, but honestly, I might have to come back to that one just because I have favorite books, but I don't know that I have.
Somebody that you've heard over time people recommend, some book that comes to mind that people talk about, anything that
one that's always come up for me has just been Great Gatsby, but that's strictly an entertainment read. Animal Farm kind of falls in that same grouping of entertaining read, but I don't know that it has a lot of business world application. So I wish I had a better answer for y'all there, but I just
Gatsby the same as the movie book?
Same as the movie book, yeah.
Oh,
yeah. And they actually did a pretty good job of capturing most elements of the book in the movie.
One of my favorite movies. So
one of my favorite. I've been bugging you to watch that recently, actually. So now we have to. Okay, Carl, if you had the opportunity to travel back in time, what advice would you give your younger self?
Ooh, travel back in time. Don't be afraid to take risks. Don't be afraid to step out there and, be authentically you. I think that's something that we're always all working to become better at, but, don't be afraid to be authentically you. And I think as you figure that out, more things in life will come easier to you just because it's authentic and genuine.
Absolutely. Totally agree with that.
Okay. What's the best investment you've ever made?
Best investment, honestly, the house that I bought in 2020, which unbeknownst to me at the time, I was like, oh man, I bought at the top of the market. We're about to go into a recession. It's going to take a few years to recover. Here in Dallas, it didn't take long at all. So this house has probably been the best investment, which we're actually just now, we talked in the pre-show, just now getting ready to sell it and move out. So definitely this house here.
Congratulations.
Yeah. Thank you. Thank you.
Now, okay, what's the worst investment you've ever made, and what lessons did you learn from it?
Ooh, worst investment I ever made. I don't want to say my undergraduate was a bad investment because it obviously paid dividends, but I wish I would have treated my undergraduate as more of a true learning opportunity as opposed to more of a social opportunity. I was focused on school when I was in school, but I wish I would have approached it with more earnest. Knowing now what I do currently, I wish I would have taken more interest in stats courses, economics courses, finance courses. So I don't want to say it was a bad investment by any means. I just wish I would have treated that with more earnest than I did at the time. So.
Yeah, don't we all feel?
Oh man, absolutely. Okay, this is a good one. How much would you need in the bank to retire today? What's your number?
What's my number today? Honestly, probably not much because I want to get back out and live in the country at some point. I want to live on quite a few acres and just have a simple little farm there. So I'd say enough to buy 20 acres of land and continue working and have a modest means after that. So I don't know, let's say $2.5 million.
Nice. All right, there you go.
And live the peaceful life on the
maybe 5 million with inflation. Let's go ahead and count for that. Let's say 5 million.
There we go. Perfect. Okay, Carl, if you could have dinner with someone dead or alive, who would it be?
Bob Weir would definitely be on that list. Honestly, all my answers are probably going to be musicians, funny enough.
Love
I'd say
it.
Bob Weir, Sturgill Simpson, Hernan Cataneo. He's an Argentinian DJ. I would be fascinated to hear the perspective from all sorts of different genres and just, how they approach their art and their craft.
Amazing.
Awesome.
Amazing.
Okay, if you weren't doing what you're doing today, what would you be doing now?
If I wasn't doing what I'm doing today, so my undergraduate, I intended to become a teacher upon graduating. And then I thought, well, maybe I'll go back to grad school. And then again, to our earlier conversation, just kind of stumbled into real estate. So I think if I wasn't doing what I'm doing today, I would probably go back and try to get a PhD and become a professor at a school.
Amazing.
I could see you being very good at that.
Well, thank you. Thank you.
Okay, book smarts or street smarts?
Yes, I would say that both. I would say probably a little bit of both. Probably more street smarts though. I think, and a good example is probably what y'all do. Obviously, there's a ton of literature out there that you can comb through, but at the same time, there is just a gut feeling. I'm sure y'all enter conversations where you're just like, I got a good feeling about this person, or I don't know, there's something that feels off about just the deal, or whatever it may be. So I'd say street smarts probably trumps, just because it's that intuition.
Awesome. Okay, last question, Carl. If you had $1 million cash and you had to make one investment today, literally today, what would it be?
$1 million cash and can make one investment. Honestly, I guess this kind of goes back to what we said earlier. I should already correct myself here, because I said take more risk, and I'm going to answer this with a risk averse answer. But I think I might find a way to park it in art, because apparently art is one of these, you're not going to get a ton of, I always liken it to a leadoff hitter in baseball. Art is this investment vehicle for very wealthy people that appears to be like a leadoff hitter in baseball. It doesn't hit you a lot of home runs, but it doesn't strike out either. So I might find a really unique piece of art that I think is going to hold value, and at least you've got the ability to look at it and use it and have some utilization out of it as well.
Wow,
Amazing.
that's really cool. That's
That
the
is
first
cool.
time somebody said that
No,
before.
it's huge business.
Yeah.
Huge.
Yeah.
Huge.
Nice, Carl. Okay, Carl, what is the best way people can reach you? If you can just let everybody know, please.
Yeah, absolutely. So as August has mentioned, I'm pretty active on LinkedIn. Certainly feel free to search my name on there. We'll say something about RealPage. I'm happy to connect with whoever. We do also have our realpage.com/analytics site, and that's where my team and our content team posts a lot of market updates and intel there. Honestly, I don't have any social media, so I don't have anywhere that would be easy to reach out other than LinkedIn. So I'd say that LinkedIn and realpage.com/analytics or realpage.com/webcasts, where we host a lot of our recorded sessions.
Amazing. Carl, don't log off yet. We really appreciate it. We're going to have a quick chat with you, but really appreciate you coming here, taking time out of your busy schedule. Like I said, we're huge fans of you and all the data that you and your group, provide. So thank you.
Thank you so much, Carl, for being here.
Sounds good. Thank y'all so much.